Successful investing is about managing risk, not avoiding it. The intelligent investor is a realist who sells to optimists and buys from pessimists. The essence of investment management is the management of risks, not the management of returns. In the short run, the market is a voting machine, but in the long run it is a weighing machine. The intelligent investor should recognize that market panics can create great prices for good companies and good prices for great companies. Investing isn't about beating others at their game. It's about controlling yourself at your own game. Investing is most intelligent when it is most businesslike. A great company is not a great investment if you pay too much for the stock. The investor's chief problem, and even his worst enemy, is likely to be himself. Never buy a stock immediately after a substantial rise or sell one immediately after a substantial drop. Successful investing professionals are disciplined and consistent, and they think a great deal about what they do and how they do it. People who invest make money for themselves. People who speculate make money for their brokers. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Individuals who cannot master their emotions are ill-suited to profit from the investment process. The function of the margin of safety is, in essence, that of rendering unnecessary an accurate estimate of the future. You must never delude yourself into thinking that you're investing when you're speculating. Before you invest, you must ensure that you have realistically assessed your probability of being right and how you will react to the consequences of being wrong. If you are shopping for common stocks, choose them the way you would buy groceries, not the way you would buy perfume. The intelligent investor is likely to need considerable willpower to keep from following the crowd. The sillier the market's behavior, the greater the opportunity for the business-like investor. In the old legend, the wise men finally boiled down the history of mortal affairs into a single phrase: "This too will pass." Although there are good and bad companies, there is no such thing as a good stock. There are only good stock prices, which come and go. margin of safety is always dependent on the price paid. It will be large at one price, small at some higher price, non-existent at some still higher price. The intelligent investor gets interested in big growth stocks not when they are at their most popular, but when something goes wrong. By refusing to pay too much for an investment, you minimize the chances that your wealth will ever disappear or suddenly be destroyed.